Random Walk Down Wall Street.
Right.
A classic guide to investing.
Yes.
And we're going to break down...
How we can help people make some smarter decisions.
Some of the key ideas.
With their money.
And try to figure out how they can help you make smarter decisions with your money.
Exactly.
Ever feel like the stock market is just a chaotic...
There's a book for you.
Whirlwind.
If you feel that way.
Yeah.
Yeah.
You're not alone.
That's where the concept of efficient markets comes in.
So right.
You know, imagine trying to predict where a feather will land in a windstorm.
Some secret.
That's kind of what it's like trying to consistently outsmart the market.
Like, is it?
Efficient markets means stock prices already reflect all known information, making it incredibly tough to find those hidden gem stocks that everybody wants.
Those hidden gem stocks.
Right.
Like, is that?
Not quite. Right. The book's core idea is that stock prices often behave like a random walk.
So it's not about finding some secret formula.
Think of it like a bee flitting between flowers, seemingly without a set pattern. This randomness makes short-term market predictions incredibly difficult.
If it's all random, how can anyone make money?
Right.
Should we just
Very good question.
throw darts at a stock listing?
That's where the idea of active versus passive investing comes in. So active management is like trying to pick the fastest horse in a race, constantly buying and selling to try and beat the market. But this often leads to underperformance, especially after you factor in fees.
It's like trying to...
Passive investing, on the other hand, is like hopping on a reliable train that steadily moves towards your destination.
So passive investing is less about...
You set it and you forget it.
Trying to outsmart the market?
To some degree.
And more about going along for the ride.
Exactly. Index funds are a great example of passive investing.
So are there...
They essentially let you buy a piece of the entire market.
Are index funds considered passive investing?
Sort of like owning a diverse collection of rare stamps. Their value grows as the market grows without you needing to constantly pick winners. And Malkiel, the author, argues that over the long haul, index funds, with their low fees, often beat those high-priced active managers.
Picking winners. You're just riding the wave.
You're going with the flow of the market.
That's interesting.
You're not trying to pick individual stocks.
So
you're saying...
We're not supposed to.
Hey, I think the market as a whole is going up.
Try and predict the market.
I want to be a part of that.
What should we be focusing on?
That's a great question. And leads us to another key insight from the book. The role of psychology. See, markets aren't always perfectly rational. Think about it. Remember the dot-com bubble?
Emotions play into it.
When everyone was piling into internet stocks, that was a case of herd mentality taking over. And it didn't end well for a lot of people.
A really good point.
Yeah.
It's like that time everyone was convinced.
It's very easy to get caught up in the hype.
Those pet rocks were the future of finance.
Oh, this is the next big thing. I got to get in on this. And that's just one example of how emotions can drive markets. Understanding these common psychological biases can help you make more level-headed decisions.
That's just one example of how emotions can drive markets.
And avoid those costly emotional traps.
So it's not...
that can really set you back.
Just about the numbers. It's also about...
It's a combination of things.
Understanding how our own minds...
It's not just about the numbers.
You can work against it.
It's also about understanding yourself.
When it comes to investing.
And how you react to the market. Precisely. Investing is as much about managing your emotions as it is about managing your money. Recognizing these biases is crucial. But how do we actually put all this wisdom into practice?
But we've got to recognize that.
How do we build a portfolio that's both robust and aligned with our goals?
Biases.
Well, that's what we'll delve into next.
So we've established that trying to outsmart the market is about as effective as trying to predict the weather a year in advance.
Like a year out.
Instead.
Exactly.
We should focus on
things we can control.
Things we can control. Like our own behavior and how we build our portfolios. What exactly does that look like in practice?
Well, you know, Think of building a portfolio like constructing a sturdy house. You wouldn't build a house on just one pillar, right?
Right.
You'd want a solid foundation with multiple supports to withstand any storm.
Yeah.
Diversifying your investments is similar.
Okay.
Spreading your money across different asset classes helps to reduce your overall risk.
Okay, so instead of putting all our eggs in one basket.
Right, don't put all your eggs in one basket.
We spread them out across different types of investments.
Precisely. That means not just stocks, but also bonds.
Okay.
Real estate.
Real estate.
Maybe even commodities like gold.
Commodities.
Now, stocks have historically offered higher growth potential, but also come with more volatility.
Higher risk, higher reward.
Bonds tend to be more stable, but might not grow as quickly.
So how do we decide how much to put in each?
Yeah.
Is there like a...
That's a great question.
Magic formula?
There's no one-size-fits-all answer.
Okay.
But your asset allocation should be tailored to your individual circumstances. Think about your age, your risk tolerance, and your financial goals.
Right.
Someone in their 20s with a long time horizon might be more comfortable with a higher allocation to stocks.
Right.
While someone nearing retirement might favor a more conservative approach.
Yeah.
With more bonds.
More bonds, yeah. So it's about finding the right balance for your individual situation.
It really depends on your individual situation and your goals and your risk tolerance.
But even within each asset class.
Exactly.
We can diversify further.
Absolutely. Imagine you're building a house and you only use one type of wood.
Okay.
What happens if that wood is susceptible to termites?
Uh-oh.
You want a variety of materials to make your house more resilient.
Makes sense.
Investing is similar.
Okay.
Within stocks, for example, you might invest in different sectors like technology, healthcare, energy, and even international markets.
So instead of betting on like a single tech stock, we could invest in like...
You could invest in...
a broader tech sector fund.
Broader fund.
That holds a basket of different tech companies.
Exactly. That way, even if one company within that sector struggles, the others can help cushion the blow.
Cushions the blow.
And MALKIEL is a big proponent of using low-cost index funds to achieve this diversification.
He really seems to love those index funds. Why is that?
Well, remember how we talked about active managers constantly trying to time the market or find hidden gems?
Right.
Index funds take the opposite approach.
Okay.
They simply track a specific market index like the S&P 500.
Okay.
They're like autopilot for your investments.
So you're not trying to outsmart the market.
You're not trying to outsmart the market.
Yeah, you're
just capturing the market's overall growth.
The market's overall growth.
At a very low cost.
And those low fees can make a big difference over time, right?
Absolutely. Think of it like this.
Okay.
Imagine two hikers setting off on the same trail. One hiker carries a heavy backpack full of unnecessary gear, slowing them down and making the journey more difficult.
Right.
The other hiker packs light, allowing them to move more quickly and efficiently.
Yeah.
Those high fees on actively managed funds are like that heavy backpack.
Okay.
They can weigh down your returns over the long run.
That's a great analogy.
Thank you.
So with index funds, we're essentially packing light and letting the power of compounding work its magic over time.
You let it do its thing.
But we still have to make some active decisions, right? Like, how do we know when to adjust our portfolio?
That's where the concept of rebalancing comes in.
Okay.
Think of it like keeping your house level.
Okay.
Over time, one side of your house might start to sink a little.
Okay.
So you'd need to make some adjustments to bring it back into balance.
To level it out.
Rebalancing your portfolio is similar. It's the process of periodically adjusting your asset allocation back to your target mix.
So let's say my target is to have 60% stocks and 40% bonds.
Right.
If the stock market has a phenomenal year and my portfolio suddenly at 70% stocks, I'd need to sell some of my stocks and buy more bonds to bring it back to that 60-40 split.
Exactly. And how often you rebalance depends on your risk tolerance and how far your portfolio has strayed from your target.
Okay.
It's like checking the foundation of your house every so often to make sure it's still sturdy and level.
Makes sense. It's not about constantly tinkering, but more about making sure things are still aligned with your plan.
Exactly.
But remember, even the most meticulously crafted portfolio can be affected by unforeseen events.
Yeah.
Markets can be volatile in the short term.
The market does what the market's going to do.
Right. Just like we can't predict the weather perfectly.
Yes. Unexpected storms can still happen in the market. It's unpredictable. How do we navigate those rough patches? That's a great question. Without making rash decisions. That's where understanding those psychological biases we discussed earlier becomes incredibly important. Think back to the dot-com bubble. When everyone was panicking and selling their tech stocks. It was often those who stayed calm and disciplined, who came out ahead in the long run. So it's not about trying to time the market perfectly. You can't time the market. But rather about having a plan. And sticking with it through thick and thin. Exactly. Investing is a marathon, not a sprint. It's about making informed decisions, managing your emotions, and staying focused on your long-term goals.
And that sounds like Malkiel's book, A Random Walk Down Wall Street.
It's a great guide.
Provides a great roadmap for navigating this complex and sometimes unpredictable world of investing.
Absolutely. It's packed with practical advice and timeless wisdom that can help investors of all levels make smarter decisions and build a more secure financial future.
So we've talked about efficient markets. We've talked about the random walk of stock prices, the importance of diversification, and low-cost index funds.
It's very important.
And even how our own psychology can impact our investment decisions.
Yeah, you can't forget about that.
It's a lot to digest.
Absolutely.
What are some key takeaways you hope listeners will remember from A Random Walk Down Wall Street?
Well, I think the most important takeaway is that investing doesn't have to be this complicated, mysterious endeavor reserved for Wall Street insiders. Malkiel does a fantastic job of demystifying the process, showing that with a bit of knowledge and discipline, anyone can become a successful investor.
It's about empowering ourselves to take control of our financial future.
Exactly. And that starts with understanding that trying to outsmart the market is usually a losing game. Embrace the randomness, accept that you won't always be right, and focus on building a portfolio that can weather those inevitable market storms.
It's like we talked about earlier. Passive investing through index funds is like getting on that reliable train that steadily moves towards your destination.
Precisely. And remember those fees we discussed. Those seemingly small percentages can make a huge difference over time. Choosing low-cost index funds over actively managed funds. It's like opting for the scenic route that saves you money on tolls.
It's those little choices that can really add up over the long run.
Absolutely. And speaking of the long run, another crucial takeaway is that time is your greatest ally when it comes to investing. The longer you stay invested, the more opportunity your money has to grow and compound.
It's like planting a tree. You wouldn't dig it up every few months to see if it's growing right. You'd give it time to take root and flourish.
Let it grow.
Investing is similar.
That's a great analogy. And just like a tree benefits from regular care and attention. So too does your portfolio. Regularly rebalancing to ensure you're still on track with your goals. Staying informed about market trends and resisting the urge to make impulsive decisions based on short-term fluctuations are all part of being a responsible investor.
So it's not about setting it and forgetting it entirely. We still need to be engaged.
You got to stay engaged.
And make adjustments as needed.
You don't want to completely forget about it.
But remember, those adjustments should be based on your overall plan and your long-term goals.
Exactly.
Not on the latest headlines or market panic.
Don't panic.
Malkiel's book really underscores the importance of discipline and patience.
Yes, very important.
It's about focusing on what we can control, rather than trying to predict the unpredictable.
The unpredictable.
Absolutely. And that includes controlling our own emotions.
Yes.
Remember those behavioral biases we talked about?
Oh, yeah, they can really get you.
Recognizing our tendency to follow the crowd, get overly confident, or fixate on losses can help us avoid making those knee-jerk reactions that can sabotage our long-term success.
Exactly.
It's about being aware of our own psychological blind spots and making decisions based on logic and reason, not fear or greed.
Very well said.
A Random Walk Down Wall Street is a fantastic resource.
It really is.
For anyone who wants to learn more about investing.
Absolutely.
It's packed with valuable insights and practical advice that can help us navigate the complexities of the market and build a more secure financial future.
I couldn't agree more. Well, that about wraps up our deep dive into a random walk down Wall Street.
It was a good one. Hopefully you've gained some valuable insights and feel more empowered to make informed decisions about your own investments.
We hope so.
Remember, stay curious, stay disciplined, and always keep learning.
Yes, never stop learning.
And, most importantly, remember to enjoy the journey.
That's right.
Investing can be both rewarding and intellectually stimulating.
It really can be.
So stay engaged, keep asking questions, and never stop exploring.
Absolutely.
Thanks for joining us on this deep dive.
It was a pleasure being here.
Until next time, happy investing.